Hello buddies, I am Shivakumar Lachapeta, a certified equity research analyst, stock market investor and F&O trader with more than 5 years of experience in the stock markets. Similar to the earlier videos, this video is also for beginners in the stock markets and for people interested in stock market investments. In this video, we will discuss two important factors that influence stock markets. Number 1, interest rates. Number 2, inflation rates. Note, whatever information I am providing in this video is only for educational purpose and should not be considered as an investment advice. Make sure you consult a financial advisor before making any investments in stock markets. So, number 1, interest rates. For businesses to run and expand, the corporations and financial institutions like banks, NBFCs, etc. have to borrow money from each other or central bank. The interest charged by central bank, in our case RBI or Reserve Bank of India, to lend money to the commercial banks is referred to as repo rate. The full form of repo is repurchasing option or repurchasing agreement. I will repeat the definition again. The interest charged by the central bank RBI for India to lend money to the commercial banks is referred to as repo rate. The full form of repo is repurchasing option or repurchasing agreement. In the same way, banks also deposit their surplus money with RBI. The interest paid on that money by RBI is known as reverse repo rate. I will repeat this again. The banks also deposit their surplus money with RBI. The interest paid on that money by RBI is known as reverse repo rate. Out of the two terms, repo rate is the most important one. It is used by RBI as a tool to control inflation. The Reserve Bank of India also uses repo rate to regulate liquidity in the economy. The central bank lends short-term loans against securities such as treasury bills and government bonds to commercial banks. The RBI increases the repo rate if there is a need to control prices and restrict borrowings. An increase in repo rate means commercial banks have to pay more interest for the money lent to them. Eventually, a change in repo rate affects public's borrowings such as home loans, EMIs, etc. That's the reason why your home loan EMIs rise every time repo rate is increased. The rise in repo rate has a ripple effect on all borrowing costs for companies and consumers in the economy. The financial institutions and companies will pass on these adverse effects onto end users or consumers. This results in a temporary halt of the expanding economy and things slow down since people stop taking loans and purchasing things. As a result of this, the earnings of companies take a hit. The stock prices also come down since the earnings are not good. Investors also divest some portion of their money from stock markets and invest in low risk assets like bonds. Since the central bank have raised interest rates, they will also get better yields from the bonds. As a result of both decreased earnings and withdrawal of funds from investors, stock markets start plummeting or crashing until there is some certainty in the economy. On the contrary, the RBI decreases the repo rate when there is a need to infuse more money into the market and support economic growth. Companies and financial institutions take more loans. People get loans for lower interest rates and starts buying things. As a result, economy gets back on track again. GDP starts growing faster. The companies generate better earnings and stock prices rise again. It is a cycle of ups and downs in the market. To summarize the whole scenario, the higher the interest rates, the worse it is for stock markets and vice versa. In the US, the terms used are slightly different. Discount rate Discount rate is the interest rate Fed charges for banks to borrow from it. Federal funds rate is the interest rate that banks charge each other for lending or borrowing from one another. Federal fund rate is the most important one and has direct effect on US stock markets. Number 2. Inflation rate. Inflation refers to the increase in price of goods and services, thus reducing the purchasing power of currencies like rupees and dollars. I will repeat the definition again. Inflation means the increase in the price of goods and services, thus reducing the purchasing power of currencies like rupees and dollars. Because the prices are getting higher, consumers have to pay more units of currency for same goods and services. Unless the income of consumers rises accordingly, the inflation can cause damage to economic growth and cause unemployment. Rising inflation is a direct threat to corporates since their expenses also go up proportionately to inflation rates. As a result, their earnings reduce unless they also increase the price of their end products. So, stock markets are inversely related to the inflation rates. The first step central bank does to control inflation is to raise interest rates, which we have talked about earlier. We will now discuss about effect of inflation and interest rate on stock markets. I am going to compare Indian and US stock markets on how they performed related to inflation and interest rates respectively. Nifty 50 or National Stock Exchange 50 is our national index. Let us see how Nifty performed since January 2020 pre-COVID to current situation. For Indian markets, repo rate is the most important and it is considered as the interest rate. We can see that interest rate and inflation have been very well managed in India thanks to RBI and Finance Ministry of India. The interest rates are up 14.56% and inflation is down 2.24% when compared to their respective values in January 2020, whereas Nifty is up by 43.6% in 2 years 9 months, which is a tremendous performance. Let us come to US markets. Dow Jones Industrial Average or US 30 is taken as reference for US stock markets. Federal fund rate is taken as interest rate here. It is clear that things are far worse in the US. Interest rates are up 85.7% and inflation has soared by 228% since January 2020. All of this is a direct consequence of quantitative easing or QE during COVID-19 times. I will explain about quantitative easing in some other video. For now, know that QE or quantitative easing means pumping of ready-made currency into the markets and economy through stimulus packages. That's what US government did during COVID times, pumping out trillions of dollars worth stimulus packages. This is a very important concept and every investor should have an idea how inflation and interest rates affect stock markets. Watch the video once again to understand it better. That's it buddies. I hope this video is informative and you understood why Indian markets are performing better compared to the US markets since last 2 years. If you like the video, share it with your friends. Thank you, take care and goodbye.